give me 1 second. This is kind of changing on me. Sorry about that. But anyway, so yeah, I just wanted to talk about the price non-movers. Josh just went over the movers. The price non-movers are essentially just the opposite of that, right? The movers, we're looking for the stock to make a move, and then the price non-movers, we're looking for it to not move. Like Sudhir mentioned previously on the call, last quarter, I used the short strangles, the short straddles for the non-movers. But to Sudhir's point, you're taking up a lot of capital when you're doing these because you're basically selling a call and selling a put naked. So there is a lot of margin that's involved, a lot of risk that's involved as well. So I transitioned this strategy or this earnings non-mover similar to what I'm doing with the volatility crush trades, and I'm using the iron butterfly trade for it. Those are all the results that I have at this point in time. But if someone on the call or anybody is interested in looking at just the short strangle or the short straddle, feel free to contact me and we can kind of run through those tests, run through those results, and I can show you how to do that. But there was few and far between that we started working with that wanted to take on that much risk just based on an earnings announcement. So I wanted to change the strategy, and we'll see those results on the slides here. So the price non-mover, again, some of the company's earnings reports, they consistently produce small stock price changes after their announcement. So historically, it'll fall below what the market makers are anticipating. And that's what we're going to call as a non-mover. Typically on these non-movers, we're looking to capture 15% profit on the trade. And we're going to use, again, the iron butterfly trade. I'll show you everybody an example of that using the Delphian virtual portfolio. So hopefully you can get an idea of what I'm talking about if you're not familiar with the iron butterfly. And we're basically going to do that coming into the earnings announcement and then get out the day after the earnings announcement. So when you're looking for a 15% gain on a trade like an iron butterfly or like a short straddle or a short strangle, you're selling the trade to enter to the trade. So you're selling it, you're collecting your credit, you're collecting the premium ahead of time. So when I'm talking about a 15% gain, I'm looking to capture at least 15% of the premium that I collected. So in a situation like this, if I'm able to collect $1,000 credit for the trade, and if I can get out by collecting, or excuse me, if I can get out by buying the trade back for $850 the next day, I'm making that $150 profit in that 12-hour, that 24-hour window, and I'm able to move on to the next trade. So that's what we're talking about when you're talking about looking at a profit on trades such as these. So the trade's closed when any of the following conditions are met. Again, the profit target's met. Typically, your stop loss isn't going to be met within that short time frame, but a stop loss or the day after the earnings release. Typically, these options, you're looking to trade, weekly options that are expiring, in 2 weeks or so, 6 days, 10 days. So when you're talking about 1 day out of the 6, you're typically not going to hit your stop loss, but you always have the chance to close the trade out if you feel that the stock is just making a big move post earnings and you want to close the trade. The beauty with the iron butterflies though is you are protected on the upside and the downside by buying options or buying the wings. So when you are protected such as that, typically before you put the trade on, or all the times before you put these trades on, you should know what your risk is, and then you should obviously be comfortable taking that risk when you're putting that trade on. Again, the iron butterfly is designed to profit with the lack of movement in the stock after the earnings announcement. So again, you have limited risk exposure because you do have those wings on the outside that you're purchasing, and most of the iron butterflies trades do offer a great risk to reward. So the reward is usually substantially higher than the risk that you have on the trade. And then the reward, obviously, when we're talking about a reward on these trades, we're talking about a total reward is going out for the options all the way to the options expire, which for the most part, we're not looking at that far out on these trades, but nonetheless, that is there whenever you're figuring out the rich reward on these trades. Short straddles and short strangles, they do offer a better credit or a higher potential reward for these trades, but again, like we spoke about, the margin's a little bit higher, and then also if you're offering yourself a higher credit or high reward, you're typically going to be increasing your risk as well. And these trades are, the short straddle, short strangles are risk unlimited because the stock can move, in theory to infinity. Long strategies on these typically aren't going to be your best trades because the stock's not looking to move. You're not expecting the stock to move. But again, you can test different strategies like your short call spreads, your bail call spreads, or your your bull put spreads. Those are trades that you could test out to see if they would offer a similar type of result. And if you get some good results when you're back testing it using Delphian, then by all means, those are trades that could be implemented for yourself as well. The trading strategy here is an iron butterfly like we spoke about. We're looking to enter in the day or the time before. So we're looking to enter in right before the earnings announcement. And then as you can see here, we're looking to exit the day after the earnings announcement. Again, I'm looking at a profit percentage of 15% of my max profit. And again, selling or getting a credit, my max profit is going to be the credit that I receive initially when I sell the trade. I put stop loss at 400% because again, typically I'm not going to hold these options until expiration. So that 400% stop loss isn't going to be a factor. I just put that in there for something for the system to kind of result in. And then days to expire, I'm using 6 days to expire and I'm using weekly options. So if you want to think about it, if I'm doing a trade today for the non-mover that has earnings coming out tonight or tomorrow morning, I'm going to be trying to trade options that have next week's expiration. That just gives me a little bit more time and a little bit more leeway in case the stock does move huge outside and I want to hold the trade maybe a little bit longer. We didn't test it that way. Again, we're testing it to get out the very next day, but that does kind of give you another out, for the lack of a better word, if you want to do that. So I'm using days to expire, 6 days, next Friday's expiration, weekly options. If you wanted to use this week's expiration, you could change the days to expire to 1, and that would use this week's or the next week's that's available options expiration. The non-mover, we basically are using, when I'm doing the butterfly, I'm selling options that are at the money. So as you see below, I'm selling the call, selling a put. Percentage from current closing price is 0.01%, so right at the money. And then my wings are basically, I'm using options. I'm using a call option that's 10% above the current close price and then 10% below the current close price. And the reason I use that is because when I tested the non-mover strategy, I used that as one of my screeners to test out stocks that typically do not move greater than plus or minus 10% coming into their earnings announcement. So that was one of the screeners that I used to find symbols that meet a strategy. And then when I found those symbols, then I want to make sure and employ that or put that into my strategy selection, the type of option strategy that I'm using. And here, as you can see here, is part of the screener that I use to find those different symbols for this particular non-mover section. I use the main screener that I use is the earnings screener, which is price change is less than or equal to either direction, 10% move from earnings day to the day after earnings, and it has to happen 6 out of 10 times. I use 6 out of 10 times just to kind of have my sample size be a little bit bigger. But if you wanted to be more narrow and have fewer selections, but possibly better candidates, you could change that selection. Instead of being 6 out of 10 earnings, maybe you could change it to 9 out of 10 earnings. So a stock that has moved less than 10% in either direction, 9 out of the 10 past earnings. You could do that as a screener as well. All of these screeners that I have here that we've used to screen out some of these symbols, like I mentioned earlier, are customizable by you. So you can make different changes to those as you see fit, based on your particular trading strategy. At the bottom, you can see I wanted to make sure I pulled in symbols that were an asset type of equity. I only wanted to trade equity options. And then the other screeners that I have there are, an option spread. The spread difference, the bid-ask spread on the options is 0% to 1%. They had to have weekly options. And then I had used an open interest in the volume indicator or screener, that they have to have over 5,000 in open interest and in volume to be candidates. The reason I did that on these and the vol crush is basically last earnings quarter, we had a handful of symbols that would come in and show some good results, but maybe their open interest was really low or their volume was really low. And if they had a volume of 10, they maybe would come into the screener or come into that as a good trade, but then getting into that trade or getting out of that trade might prove to be a little difficult. So I tried to add the open interest and the option volume screener this go around to see if that potentially can help us out, and that seemed like it with the results. The first one I wanted to show is Delta Airlines. So similar to what Josh had shown, you can see the chart here. This chart goes all the way back to the 30th of December of last year to current day. I used a 1-year chart, and you can see, you know, the earnings symbols that we have available here. So earnings here, 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 and here. So we're looking for a stock that typically is a non-mover, you know, barring this little blip up here off of earnings over to the far left. The stock jumped up, it looked like, off of earnings, but other than that, we can see the stock kind of went down a little bit sideways, up a little bit sideways, and kind of moved sideways. So really with a non-mover, that's essentially what you're looking for. Here are the trade layouts. So when I ran the test using Delta Airlines for that particular strategy, the non-mover, and the trade strategy, like I showed before, the iron butterfly, you can see my results here for the past 10 quarters, the credit you receive versus the profit. Now remember, you know, we're getting in one day and getting out the very next day. So, you know, our profits aren't going to be as glorious as you might see some of the other trades if you're holding them for a little bit longer. But, you know, when you're looking at your potential profit versus your risk, when we see those a little bit later, you can see the difference in those. Here's the breakdown. So for Delta Airlines, using the non-mover strategy and using the iron butterfly trading strategy like we spoke about, we had a 90% win rate over the past 10 quarters, 6250 profit factor, and the total, this is the total profit combined. But really what we're looking at, you know, profit factor and your win percentage. The next one that I'm talking about is Chipotle. So Chipotle was another one that had come up as a non-mover, and we can see similar fashion here, how the earnings, we get a little drop and then kind of sideways action, spike back up. Here you had pretty decent spike up, but then sideways action. So really looking for some of these kind of, you know, non-movements, if you will. And then Chipotle, you can see with the trade result here. So this, you know, this trade 10, I didn't show you on the Delta, but trade 10 is going to be the last quarter's results that we have here. So Chipotle, the stock, if you look on this page here, you know, the stock is roughly around $1,300 or so a share. So, you know, that being said, your credit and your risk is going to be substantially different for a trade such as this, because just of the actual price of the stock, and that is going to relate obviously to the price or the value of the options. And then this is showing you as well that Chipotle had an 80% win rate on the non-mover, 3.96 profit factor. And my profit here is substantially higher, but again, that's obviously relates to the value of the stock, the price of the stock, and the value of the options as well when you're trading it. I'm going to show some more details later in some of the other slides, details being some screenshots from the system, and you can look at the actual trades. But Josh went through the mover on this one, so I'm kind of going through the non-mover a little bit faster. Based on the non-mover plan that we had set up, there's 37 symbols that have met that criteria. And basically what I did was a little bit different from Josh. They had to have a profit factor above 2.0. I used the iron butterfly strategy again, so I was able to be a little bit less, or a little bit more aggressive, I guess, or less of the profit factor. So I used a 2 instead of 3. But we can see that out of those 37 trades, you know, there was 12 potential trades in the Q4 earnings that had a win percentage between 70 and 79%, 13 between 80 and 89, and 5 that were between 90 and 100. So the remainder of those that we have there, the 7, are going to be less than that 70%, the 70% win rate. So, but they still had above a profit factor of 2.0. With the iron butterfly, the way that the trade is constructed, some of your win percentage, it's a little bit more difficult to get some of those winning percentages, you know, above the 80% like we're looking at when we're talking about the bullish pre-runners. So that's why with some of the iron butterfly trades, I can be a little more lenient on what I'm looking at when I'm looking at my win percentages. Sorry if I'm fading out a little bit. I'm using a headset and it seems to be kind of losing some of my voice, so I apologize. I'm trying to make it sound the best I can, but please put something in there if I am fading out. The trade entry on the iron butterflies, you know, we obviously want to make sure that we know when we're entering the iron butterfly trade that, you know, if the earnings announcement is before market open, then you have to enter in the trade the day before the earnings. So if Microsoft was having earnings tomorrow morning, we couldn't get into the trade before earnings announcement tomorrow morning, so we'd have to enter that trade in today before they close. And the same thing with if Microsoft is having earnings announcement by the end of the day, then we'll want to make sure we're getting into the trade before they close today because their earnings is going to be tonight. Always with the iron butterflies, verify your risk versus your reward. Typically, I'm going to look at my implied volatility just to make sure that my implied volatility is a little bit higher than normal. The reason I'm doing that is because I'm selling both the call and a put that's at the money. And after the earnings announcement, I kind of want that implied volatility to go down. And if it does, that should obviously decrease the value of those options that I sold previously. Option open interest and option volume, again, the higher the better on these. I mean, you can trade those trades when your volume or your open interest is low, but always be prepared that, if it's easy to get into the trade and, there's only a handful of people out there that are trading that particular option, it might be difficult to get out tomorrow when you're wanting to get out because there just might not be any, any sellers out there for you. So just be careful. Josh mentioned it before, always use limit orders when you're entering trades, especially on these iron butterfly trades. It is a four-legged option trade, so you're dealing with 4 different legs. So you always want to make sure you're using a limit order. Always understand your potential risk, and then always have a trading plan. So always have a plan in place to say, once I get into the trade, if this happens, then I'm going to do that. And that goes back to something Saphir had mentioned earlier regarding the ex-dividend date and being assigned shares. If you're assigned shares or if you're assigned on short options that you have and your trade is together as a whole, that being assigned doesn't really impact the trade. It might impact your account margin wise or the different account information that you might have on your trading account. But as a trade, it doesn't affect it too much. You just want to make sure you're exiting the long shares or the short shares at the same time that you're exiting the other options as well. So the trade exit, again, like Josh mentioned, once you enter in the trade and it's complete, you're filled on the order, I would go ahead and put my exit order in at 15% profit. I typically put them in GTC, but again, if you're getting out the very next day or that same day, depending on when the earnings announcement was, you can just put in your 15% exit and just, you don't have to worry about the GTC order. You're always going to exit the trade again prior to the close of the following day after the earnings release. Sometimes depending on what the stock is doing, this exit can be just a little bit, but just note that when we test these trades, we're testing them based on the criteria that we're showing here. Doesn't mean that it's not the most optimized or the best exit or the best criteria for that particular trade, but based on our results, we're using this criteria that we're showing. Again, additional notes, the iron butterfly entails selling options that are at or in the money, so there's always the potential to be exercised. We talked about this earlier, and again, the iron butterfly has 4 legs of options, so make sure you're using different prices in mind when you're trying to get into the trade, and never really chase a fill price. Just keep in mind your risk to reward that you have set up, and make sure you're not kind of violating and getting yourself into a bad position by trying to chase a fill price just to get into a trade. What I wanted to do, so that's the end of that one there, but what I would like to show you is I want to show you an example for anyone on the call that might not know what an iron butterfly is or what an iron butterfly trade would look like. So I'm going to use the virtual portfolio real quickly to kind of show you what that trade looks like. And then if anybody has any questions on that non-mover or this setup, please let me know. So I'm going to go into the Delphian virtual portfolio. I already have one set up for the earnings vol crush, but I'm going to use that non-mover in this particular section just to give you an idea of how that looks like, because it does relate the same to the actual vol crush trade as well, which I'm going to go over next. If I want to add a position, I'm going to hit add a position to this virtual portfolio. I know there's one on the vol crush, which is, like I said, is similar to the non-mover that's coming out today. So I'm going to use that, which is Lanier, L-E-N. I'm going to select my strategy, which is my iron butterfly. I'm going to look at the options that expire this Friday, just to give you an idea. Now, Lanier is around $74 right now. So I'm going to basically put in 74. And typically with these iron butterflies, and when you're doing iron butterflies and you're basing it on expected move, or like in that other scenario, you're basing it on 10% away from the stock price, you would want to construct it differently. But for the non-mover, we're using 10% from the actual current price of the actual stock. So that being said, and since I showed you that 6 days to expiration using those weekly options, I actually want to change it to next week's expiration just to kind of show you exactly what we're talking about. So the stock's at 74. So if I'm doing 10% from the current market price, we're roughly going to be looking at, let's just say $7, $7. So I'm going to be looking at an 81 on the call side, and then let's look at 7 on the bottom. So we're going to be talking about 67. And so this is what the iron butterfly trade would look like. This is what your risk to reward scenario would look like. So I want to show you, if I was constructing this trade as a non-mover based on 10% to each side using next week's expiration, my max profit, which is again the credit that I receive on this trade, is $425. So I'm going to collect $425 to put this trade on. And now my max risk on this trade is $7 because that's my difference between my two strikes. So 700 is my max risk, but when I'm collecting 425, I'm looking at 700 minus 425. So my actual risk is going to be $275. Now, we also show you within the virtual portfolio, we give you your break-even prices here. So our break-even prices take into an account the credit that we receive on the trade. So you can see the credit that we receive versus the options that we sold, that's giving us our break-even prices. And you can see here, based on the graph, you can see the difference in if the stock moves up too far, I'm losing money, or if the stock drops down too far, I'm losing money. Typically, we want it to stay, within that sweet spot, which is going to be your break-even prices. So that just kind of shows you the construction of the trade. And within the platform, you can see, we have your deltas of the options here. You can see that, and you can also see your bid-ask spread too. So does anybody have any questions on, the iron butterfly or how that trade is constructed? It's a little bit of a complicated trade because you are talking about 4 legs, but that's the beauty about the virtual portfolio here within Delphian is you can test it, you can put those into your virtual portfolio, track them without trading them live and without risking your money, and see how they work over time. Do we have any questions, Josh?
No, nothing.
All right, good. I've explained it a lot, so I hope that I've learned to explain that one pretty well. But you never know. Again, when you're talking about four-legged options, it is a difficult one sometimes.